Assalamualaikum to our beloved Madam Puan ZURAIDAH. Today I will present for the question 1 of our FAR project. For the question 1A, how is the accounting treatment for Venus and Mars? So for this, Mercury should since Mercury acquire Venus and Mars more than 50%, so both are subsidiaries to Mercury. The accounting treatment for both subsidiaries is to consolidate financial statement and using acquisition methods. So the acquisition method is applied on the date of acquisition, which is for Venus from the 1st January 2018 and for Mars is 1st July 2018. So Mercury should recognize the cost of business combination, which comprise of consideration transferred and identifiable asset acquired and also the liabilities. So all the asset acquired and liabilities should be measured at fair value during the date of acquisition. And lastly is to determine the goodwill or bargain purchase by comparing consideration transferred and amount of any NCI and fair value of net asset during of the subsidiaries. Next is question B. So for question B is how to compute goodwill or bargain purchase for both investment. So how do we calculate goodwill or bargain purchase? First, we need to find out the consideration transferred for both investment. For Venus, the consideration transferred amounting to 3,600,000 ringgit. So next, we need to find out what is the amount of NCI value. How do we calculate NCI? Firstly, we need to know that this question using partial goodwill as a method to calculate two value. Since the parent acquire Venus at a percentage of control 60%, so the NCI will be 40%. So the 40% will be multiplied by the fair value of net asset during acquisition, which is amounting to 5,600,000 ringgit. So the amount of NCI plus with the consideration transferred will be compared with fair value of net asset during the acquisition. So the amount comparable or the balance of the compared amount will be goodwill and the bargain purchase. For Venus, we will get the amount of goodwill amounting to 240,000. However, for Venus, during the year end, there will be a goodwill impairment of goodwill amounting to 5%. So the 5% will be multiplied with the goodwill and resulting 12,000 and left goodwill impaired with 228,000. Besides that, the parent also acquire preference share amounting to 40% of the preference share. So which resulting that NCI have a percentage of control amounting to 60%. So the amount of NCI should be recorded under the NCI column will be 600,000 ringgit Malaysia. Besides the parent acquire ordinary share, the parent also acquire 10% debentures of Venus. So the amount of debentures acquired by the parent is amounting to 100% of percentage of control. So there is no amount of NCI mounting for the Venus for the debentures. For Mars, the goodwill computation is the same application we use as Venus. However, for the amount goodwill, for the amount of comparable is that we found there will be the amount of consideration transferred and NCI will be lesser than the fair value of net asset during the acquisition. Thus, it will result in bargain purchase amounting to 700,000. Alright, for the next question is C, where we will build up schedule for this. Firstly, we need to fill in the column of NCI, which is the amount that we calculate during the goodwill, and we fill in the NCI column for the NCI amount. And next, we will fill in the group retained profit column by fill in the retained profit of all the subsidiaries of Mercury and also the Mercury retained profit. For the subsidiaries, we need to do some adjustment, which include intercompany transaction and also any adjustment that not yet recorded, such as depreciation under provided. So for Venus, since the parent acquiring 60% of the amount, the adjusted retained profit amounting to 4,200,000 will be multiplied by 60%, and the amount will be filled in under the group retained profit column, and the balance 40% will be filled in under NCI's column.
2, 3.
The same application will be used for Mars retained profit. So the amount retained profit of Mars will be adjusted also with any intercompany transaction and also not yet recorded adjustment, and the final amount will be multiplied by the percentage of control of parent, which is for Mars is 70%, and the amount will be filled in under the group of retained profit columns, and the balance of 30% will be recorded under NCI's column. And for Mercury retained profit, we need to take into consideration all the dividends that entitled for the Mercury. Since Mercury acquire Venus and Mars, all the Venus and Mars dividend will be entitled to parents, which is Mercury, of the percentage control that he. For Venus ordinary share dividend, the Mercury entitled for 60% of dividend, and also for Mars the 70% dividend. Not to forget for the preference share of Mars that the parent entitled for 40%. And then we should not forget for the impairment of goodwill that we calculate during the computation of goodwill, and also the bargain purchase also to be included under this retained profit adjustment. So the final amount will be dedicated all under group retained profit, because the Mercury is the parent of this company, of these groups. And lastly, for group general reserve. For group general reserve, Mercury will fill in under the group general reserve all its group general reserve amount, and also its subsidiaries according to the proportion of the percentage of control. Since this question only provide for general reserve for Mars, for the general reserve of Mars, we need to take into consideration that Mars had provide bonus issue during end of year. So we need to adjust the amount of bonus issue amounting to 400,000 that is need to be deducted under the Mars general reserve. So the final amount of group general reserve, group retained profit, and NCIs will be all recorded under CSOFP. Okay, for the next question is we will prepare the consolidated statement of profit and loss for the groups, for Mercury and its group. So under this consolidated statement of profit or loss, we will consolidate all the transaction, all the elements in the statement of profit or loss for Mercury and both of its subsidiaries. But we need to take into consideration that since the Mercury acquire Mars for half of the year, so we need to proportion of the elements under the statement of profit or loss for Mars to be portioned with half of the year. Under this statement of profit or loss, we need to provide with adjustment that is during the year. For example, the amortization, the depreciation under provided, and any other adjustments that need to be recorded. So this is the consolidated statement of profit or loss that we prepared. Please look at the screen.
Okay, let's move on to the next statement, is the consolidated statement of changes in equity. So for this statement of changes in equity, we must take into consideration, we must calculate the portion for NCI of the ordinary share of their ordinary share capital and preference share capital for Venus and Mars, both for Venus and Mars. And we must also divide the dividend given by Venus and Mars into the group return profit for the company as a whole and for the NCI for both company. Last is we must take into consideration of the bonus issue that the company Venus had given out and distribute it to both the company, the group in the group return profit under the group return profit and deduct in the NCI too. Last but not least, let's look into the next consolidated statement, which is the consolidated statement of financial position for Mercury and its group. So for this statement, we must take into account for the asset side, which we have the non-current asset and the current asset. We must take into consideration all the transaction, the additional informations given in the question. And what we have in this statement is for non-current asset we have PPE, which is property, plant and equipment, and intangible asset. But we must also remember that we have a goodwill for this consolidated statement. Next is the current asset. We will add all the information, all the numbers given and take into consideration all the adjustments. And we will have the inventories, bill receivables, account receivables and bank for.
Okay. Sama-sama.
And the total of this asset is 61,063,000. Okay, that is for the debit side. Next we have the credit side, which is the equity at non-current liability and current liability. For equity, we will have the ordinary share capital, group general reserve, group retained profit, and not to forget the NCI. For ordinary share capital, we have an additional of 2.52 million, which come from the ordinary share been issued to pay for the consideration transfer. And next, for non-current liability, we have 7% bank loan and 3% redeemable preference shares. And last, we have the current liabilities. Current liabilities, we have bills payables, ordinary dividend payable to the ordinary shareholders, and preference dividend payable for the preference shareholders, and last but not least, the account payable. So the total of this equity and liability, we have 61,063,000.
Okay, now we will go to the question 2. The question is, state the area covered by the contractual arrangement as specified under MFRS 11's joint arrangement. The parties are bound by a contractual arrangement which can be evident in writing, form of contract or document discussion between the parties. The term of the arrangement will be incorporated into the article, charter or bylaws of the parties which bears interest in the joint arrangement. Some of the area covered by the contractual arrangement are as follows. First, the activity, duration and reporting obligation of the joint arrangement. Second, the appointment of the board of director or equivalent governing body and voting right of the ventures. Third, the decision-making process, matters requiring decision by the parties and the required level of support for those matters. Fourth, capital or other contribution by the parties. And fifth, manner of sharing among the parties of the joint arrangement, asset, liabilities, revenue, expenses, profit or loss. Second, the contractual arrangement gives two or more of the parties joint control of the arrangement. The next question is, describe the joint control according to the MFRS 11 joint arrangement and provided one scenario as an example of an joint control. Joint control exists when the parties contractually agree to share control and decision about the relevant activities of the joint arrangement have the unanimous consent of all the parties sharing control. The parties have to assess the extent to which the parties should act together to direct the activities that significantly affect the return of the joint arrangement.
3.
3.
No single party control the arrangement on its own, but a party to joint control can prevent the other parties from controlling the arrangement. For example, A, B, and C are parties to an arrangement where A has 60% voting power and B has 30% and C has 10%. The contractual agreement between the three is that at least 80% of the voting rights are required to make decisions about the relevant activities of the arrangement. In this case, A and B have joint control as A needs the consent of B to make decisions about the relevant activities. C is a party to the joint arrangement. The next question is, explain the accounting treatment of each type of the joint arrangement specifically related to the right to the asset and obligation for the liabilities. Firstly, right to the asset. For a joint operation, the parties to the arrangement share all interests in the asset relating to the arrangement in a specified portion. In the separate financial statement and in the consolidated financial statement, each operator will have to disclose the asset it controls. And for joint venture, the asset brought into the arrangement or subsequently acquired by the joint arrangement are the arrangement asset. The party have no interest in the asset of the arrangement. For the venture, its contribution to the joint venture will be disclosed as an investment. They will apply equity method in consolidated financial statement. Secondly, for obligation for liabilities. For joint operation, the parties to the arrangement share all liabilities, obligation, costs and expenses in a specified proportion. The parties to the arrangement are liable for claims raised by the third parties. They will disclose liabilities incurred in separate financial statement and consolidated financial statement. For a joint venture, the joint arrangement is liable for the debt and obligation of the arrangement. The parties are liable to the arrangement to the extent of their respective investment, their obligation to contribute any unpaid or additional capital. Creditor of the arrangement do not have right of recourse against any party for debt or obligation of the arrangement.
Hi, a very good evening to all the watchers, and now let's proceed to the question 3. So for the question 3, for the question number 1, what is the relationship between Lily Berhad and Barry Berhad before and after the right issues? Okay, before the right issues, the relationship between Lily and Barry is a parent and subsidiary because during the date of initial acquisition, Lily acquires 600,000 over 800,000 of Barry shares, so it does make 75% percentage control in the Barry. While after the right issues, although there is a decreasing in the shareholding held by the Lily by a sufficient amount, but the relationship still parents and subsidiary because the percentage is 54%. Okay, for the question 3 too, it's the question asks for what is the goodwill on the initial of the acquisition. So as we know that the consideration transferred by the Lily to purchase the shares in the Barry is amounting 1.8 million. So the fair value of the asset of the Barry that time is 1.6. So we can take our 1.8 million plus NCI 25% times 1.6 million, we will get 400. So we plus both of them, we will get 2.2 million minus by the fair value of the net assets 1.6 million. So the goodwill for at the date of the acquisition will be 600,000. Let's proceed to the question 3. It's all about gain or loss that Lily incur when the company doesn't retain the same percentage of control from 75% to 54%. As we know, as on 1 May 2017, Barry issued an extra 240 unit share for Lily to subscribe, but the company, its parent itself, doesn't want to subscribe. So the new percentage of that during the subscription will be 332 units plus the 800 units that originally have by Barry's. So that makes the total share of Barry for that time is 1,120. So
since 240 unit share that Lily supposed to subscribe does not been subscribed by Lily. So the value of Barry before the right issue is 75% times with 5 million of fair value of Barry, so it's 3,750, and value of Barry after the right issue 5 million plus 2/5 times 800 times 5 equal to 3 times with 54% equal to 3564. So we minus both of them, we will get the proceed plus with the proceed sale by the Lily to the other parties 240,000 unit times 0.5, we get 120. Right, so the loss arising for not returning the same percentage is the value of 3,750 before the right issue minus 3,564 after the right issue plus and 120 equal to 60,000 loss gained by Lily. Thank you very much. Alright, for the questions 4, instead of the right issue issued by the Barry, for the question 4 want to us to find what happened if Barry put a private placement for 450,000 unit shares for amounting 3,500,000. So if we replace it with the private placement, the new percentage of control of Lily after the placement will be 48%. The value of the private placement is 450,000 units times 7 equal to 3,150. So on the date of the acquisition, Lily has 75% control in Barry. After the private placement issue, the issue was made by Barry. The number of share of Barry is increased to 1,250. Thus, the new percentage of control in Lily in Barry decreased until to 48%. Thus, Lily has lost control in Barry, become the associate. The gain on do the private placement is 3,500 minus 3,150 equal to 350. The value will be written off in standard consolidated of statement of profit or loss. Thank you very much.
We are already at question 4 now. Thank you for staying with us. Let's look into this question and extract the information first that we have in question 4. In 1 October 2017, AZHAR acquired 40% of Adam's ordinary share interest with a consideration transfer of 2,750,000, while the retained profit of Adam at that acquisition date is 200,000. And at the same time, at the same date, AZHAR acquired 50% of Adam's convertible preference. AZHAR acquired 50% of Adam convertible debentures. If converted into ordinary shares, these convertible debentures can increase AZHAR's interest in Adam by 25%. However, at the end of the financial year at 31 December 2017, none of these debentures have been converted. So, as we all know, if we have 40% ordinary share interest in a company, that company is our associate. But however, due to the convertible debenture that we have, which AZHAR have in Adam, what will happen to their relationship? These convertible debentures, if been converted, they will increase AZHAR's interest in Adam by 25%, which means from 40%, AZHAR will have 65% interest in Adam. With 65% in controlling interest, AZHAR will be a parent company for Adam, which Adam will be their subsidiary. So, in the consolidated statement, will we take Adam as our associate our subsidiary. According to MFRS 10, although the debentures were not converted at the end of the financial year, but we have to consider the existence and effect of the potential voting shares which AZHAR have, and so it will result in AZHAR having 65% at the end of the financial year in their record in Adam, and their relationship is a parent and subsidiary.
Action.
Alright, thank you for watching this video till the end, and if you have any question you would like to ask, please put down your questions in the comment box below.